Good afternoon, everyone. I'm Antonio Rodrigues, partner here at Procyon Partners, portfolio manager as well. I want to introduce you to our panelists, also partners here at Procyon. Make sure you guys turn your mics on just so we can hear you at some point. But we got Jeff Farah. He is actually filling in for Mark Rich. Mark Rich, as you saw on the invite, is our senior investment analyst. And he's down with the flu, poor guy. So we're hoping that he's getting better quicker. And he's still sending emails and he's still answering texts and all that kind of stuff. So Mark, we hope you're getting better, buddy. We got you covered. But Jeff's going to fill in for that portion. Jeff's partner, founding partner, portfolio manager as well, and the COO of our firm. Worked very closely with Mark and myself. Mike Kelly, he is the division leader for our financial planning division, also a partner here at the firm. Mike has got lots of experience doing financial planning. He helps run the entire division, and he's going to help talk a little bit about how the current market environment has really influenced some of the planning, that we've dealt with in the next year or so that we need to deal with. So thanks for joining us today. We really appreciate you coming. We hope this is going to be informational for you. We think that we've had some guests on over the last couple of webinars, which has been great. We love to get outside thoughts, but we also know that people want to hear about what we're thinking internally and what our expectations are for the coming year and beyond, of course. But before we get into the coming year, 2023, and what to expect, it's important to recap a little bit of 22. Take a few minutes to do that. So if we were coming into 2022 at the end of 2021, what 2021 really taught us was that you should buy the Fed put, buy the dip. Under any circumstances, buy the dip. That's what you need to do. It won't last long. In 2022, that was the opposite, right? Sell the rally has been sort of the tactical trading around the markets these days. And so those are two very different environments. And I would argue that buy the dip, that was so 2010s, right? 2008 up to 2020, you had a buy the dip mentality. It was a couple of negative years, but very few during that time period. And so we were supported after the great financial crisis. And so that leads us to the 2010s, and then you have OT, or overtime, in terms of quantitative easing, which is the pandemic. So pandemic shows up, now we got to print more money, no problem. So we saw the growth of the money supply essentially double during the pandemic. And that an extended period of low rates with that increased the value of most assets across the board. And so when you have low interest rates, you have quantitative easing, easy money, all that kind of stuff, increased money supply, you start to get growth of asset values. Well, that was the plan, really. I mean, that was the plan by the Fed, by the economists, to a certain extent. There are some unintended consequences that can occur. And I think what we're dealing with in 2022 and 2023 is a little bit of that. There are some other things mixed in with that. But of course, we're dealing with some issues that come with large money supplies and the printing of money in relation to crises that we've been dealing with. And so here we are. So what do we begin to see in 2022? As these sort of quantitative easing rhetoric slowed down, interest rates were going to start going up, speculative asset bubbles began to burst, right? So we saw FTX, we saw crypto come down 80-90%. That doesn't mean it's dead forever, right? Internet stocks came down to nothing in 2000. It took a long time to come back. But there are speculative asset bubbles that have started to come back down. Traditional value sectors, so, energy, healthcare, utilities, these types of things have been outperforming the growth sectors. This makes a lot of sense, given that growth companies typically are a little more sensitive to interest rate changes in their borrowing costs, especially when you have thin margins or some growth companies with negative margins, right? They've been losing money. Now they've got to borrow more at higher rates. So value stocks have done better. Commodities have come down from their peak. So we see this inflationary pressure starting to release a little bit, but not enough for everybody. It's sort of embedded. So commodities are down from their peak that they were in late 2021. In general, however, employment remained strong. While the unemployment participation rate wasn't great, it was a little higher than we'd like to see it. But those who were working really have enjoyed the benefit of massive wage increases across the board, across most sectors. Of course, there were some industries that were starting to see a little bit of layoffs and unemployment come, the growth sectors, tech sectors, and so forth. We're starting to see a little bit of that. But by and large, we're seeing workers that are working and who are employed, changing jobs, asking for raises, and their pressure is on for employers. And that's been a good thing for wages. Not great for inflation, but good for workers, as we like to see that. Supply chain shortages, right? That began in 2020, or maybe even before that, as we started to really ramp up some of the international trade negotiations with tariffs back even earlier than 2020. And so you have supply chain shortages exacerbated by demand, strength. So you have lots of money. Everybody's got plenty of money. You have supply chain shortages, and now you have money chasing not enough goods available. That increases the cost of those goods. And so you've got that sort of played itself into this. All of that's true. We've all experienced those things. But the question really became, is this real? Is it transient, right? We started to have to figure out how to define transient. Meaning, is it temporary? Is it just 1 month, just 1 quarter, maybe 2 quarters, maybe 3? Transient can mean a lot of different things. I can tell you that right now, it has not been transient per se, in the sense that higher levels of inflation have embedded themselves into the economy, and we're working our way through it. So the Fed had to figure this out. Was it going to be transient? How much were they going to actually raise the rates, right? They've said it before, they're actually going to do it. So they actually began to raise the short-term borrowing rates in large increments with the hopes of slowing demand for all things inflationary, right? That's the idea, is to slow demand a little bit, curtail the funds. Many believe that the Fed was late to act and has attempted to catch up, by basically being very aggressive with both current rate increases and rhetoric at press meetings. He's talked about, stomping it out and making sure and whatever it takes and so on and so forth. And I believe that that's true, given they have, 2 mandates. I'm going to share with you a quick chart here, just a inflationary chart that we're going to take a look at, just to show you the actual magnitude of the change, the actual magnitude of the inflation. 1 second here. So if you take a look at this is directly from BLS, which is the authority on Bureau of Labor Statistics, as well as CPI and so forth. You've got, 12-month percentage change, and this goes back 20 years or so. And you can kind of take a look through. You can kind of see it's kind of in a range. It's hit as high as 5%, maybe a little bit higher when housing was at its peak in 07, 08, but it kind of lingers in the lower range. And then you see inflation really kind of kick up right after 2020. And it's higher than it's been, since the early 1980s. And so the Fed's had to deal with that. And so when you think about that, you go, what are we supposed to do about this? Do we just stop spending money? There was in the late 70s, early 80s, there was campaigns, political campaigns, activist campaigns that actually sold buttons that said WIN on them. And the WIN stood for whip inflation now. It was a social issue. And so, right now we're trying to deal with this in a monetary sense. And here's what the Fed has done to do that. They want to slow down the flow of money and slow down the demand ultimately for some goods and services. And so what they did was let's take a look here. What they did was they ultimately raised rates so fast. I'm going to share my screen one more time so you can see this. They increased rates so fast that it's sort of parabolic. You can kind of see here on the left-hand side, this goes back to 2018. You can kind of see rates ticking upwards as we began to try to correct from the QE that was, printed during a great financial crisis. You see that heading up. 2019, things start to get a little funny, rates get cut a little bit further, and now you have the pandemic hitting, rates cut to 0 and even negative. I mean, we had negative rates in this country on the short end for a little while. And then, probably right around mid-2021, there were lots of calls for increasing rates. That stayed at 0 for a very long time, probably longer than people wanted. And they've had these massive 1/2 and 3/4 rate increases up till now. The Fed funds rate is about 3.5%, likely going to 4.25% in very short order. And so that's what they're doing. They've made a parabolic move in rates that has slowed down the housing market, that has slowed down demand for a lot of cyclical goods and items. And so that's what they wanted to do, slow down. So what did this do to the actual stock market and the equity markets and the investment markets? So I'm going to show you how everything performed. It's been a tough time, obviously, in terms of performance. But if you take a look at the actual numbers to get a gauge. So if we look at equity market performance here, I'm going to zoom this out slightly so we can see all of it. So if you look at equity market performance, the 3 major markets are the U.S., you've got international, and you've got emerging. So the U.S. S&P 500 down 16%. This is as of a couple days ago. You've got MSCI EFA, which is Europe and Japan, down about 12.5. And you've got emerging markets, which is led mostly by China and India, down about 18%. So it didn't matter where you were, you're down double digits. If you take a look at, now you've got bond returns. So bond returns are really sort of, or fixed income returns are really sort of interesting in the sense that bond investors are typically conservative investors, and they don't expect to experience large drawdowns. The next worst year to this year was 1991 or 1992, down 2% in the bond market on the ag. That was the last worst year to this one. If you look here, you're going to look at some of the different bond indices. The broadest measure is the Bloomberg US aggregate. That was down, 9% or so. You've got, actually the aggregate was down more like 11. You've got the munis held up a little bit, down 9%. So you can see you've had a 10 and 20 fold negative return in here as you had at any other time. That's way off the expectations, but it's happened. And if you go a little bit further and you look at other types of assets, you can look here at, we like to look at all different things. So you've got oil. So if you owned oil last year, you were up double digits. If you owned other stuff, you were negative, right? So you've got real estate, that was down 23%. Oil was up 15%. Gold was pretty much flat, down 2%. And the base metals, which follows gold, same thing. It's got other aluminum and so forth, down about 7%. So the other piece was cash. So if you had cash, you made about 1.5% throughout the year. Cash now pays a lot higher going forward, but that's kind of what it was. So we'll stop that for a second. So what are we looking for? In this environment, what do you need? What do we need? We need to look for some different things. Quality. So we're going to get into portfolio construction a little bit with Jeff, but in terms of quality, we're going to focus on things like free cash flow, balance sheet strength, that kind of stuff, buybacks, payout ratios. There are a number of things that occur in financially strong companies that are not necessarily part of what a growth company or a more susceptible company is doing. So we're going to talk about that. Was there a recession on the way? The Fed would like to see a continued slowdown in demand, but a recession is not what they're looking for, because that would bring with it unemployment. That unemployment would likely be too high for what we would like. And so ultimately, the Fed's not pushing for a recession, but rather focused on the CPI number, and will ultimately continue to keep rates higher, in our opinion, until unemployment maybe reaches 5% over a sustained period of time, and inflation will have to go below 6% for a sustained period of time before they change really the direction that they are at the moment. So we're going to talk a little bit about that further. So we do think that the dual mandate is being followed at the Fed, as I mentioned. So they're looking at employment as well as inflation. They're going to focus on that. The data, the inflationary points yesterday, speaking specifically of, where sort of came in a little bit under the inflationary expectations by 0.2. Previous month, same thing, 0.2 under expectations. The previous month was 0.2 over expectations. And so that helps to ease a little bit. We had a little rally in the market, and we'll see how that plays out. But I would say by and large, we're largely meeting the inflation expectations that the Fed has set and what the consensus has been. And so we don't expect the Fed to move far off of what they've forecast as their mechanisms for this year. So we're going to go over to Jeff for a couple minutes. Jeff, can you give us an idea, what the macro markets, not only what they've told us about where we've been, but maybe what they're telling us about going forward for 2023. We've got asset prices really down in areas that we've never seen before. And so we'd like to kind of get an idea about the macro market, equity, fixed interest rates, and so forth. So if you wouldn't mind, talk a little bit about our macro assumptions here.
Sure. Thanks, Antonio. I guess I'll talk in a couple of ways about what we know to be true, what we think might happen, and then some unexpecteds that may catch people by surprise. So the first thing we know to be true is that stocks always follow earnings, although it can take a little bit of time. So when we look at earnings from companies, they're doing okay. They're a little bit off the peak if you look at the S&P aggregate earnings. But companies are doing okay. It's not like 2008 or even the COVID quarter where companies shut down. So we're paying particular attention to how the company's earnings are doing. Like Antonio mentioned, companies are getting a little bit of pressure on the cost side or the input side from both employment and inputs to their products. If you go to the grocery store and buy a bag of Doritos from Pepsi, you get 3 less Doritos than you used to be, right? So they're trying to find ways to raise prices, keep revenues up, and still produce. So earnings is one thing we're keeping an eye on. And the second, of course, is the Federal Reserve, which Antonio talked about. If I could digress for a second, I just want to tell a little bit of story about the Federal Reserve. Those who know me know I love stories, and I've worked out with a small group of people every morning or 3 days a week from 6 to 7 with a trainer. And one of the reasons I love doing that is I don't have to think about what to do. I just show up at 6 and the trainer has come up with some evil little routine for me to do. And one of them I think is appropriate and kind of in parallel to what the Fed's trying to do. The Fed has a dual mandate: maintain full employment, let's call it 5%, and keep prices stable. They used to have a hard target. Now they have an average target of 2%. But that's what they're trying to do, is balance the two things. So the exercise my trainer had us do the other day is we had to row on an erg, which is like an indoor rowing device where you push with your legs, pull with your arms, and then you glide and then recover. And he said we had to row 200 meters, which takes like a minute. It doesn't take very long. But we had to stop exactly on 200 meters. And of course, since it's the gym, there was a penalty. For every meter that you went under, you and the rest of the group had to do 1 burpee. And for those who don't know what a burpee is, it's basically hop down on the floor, do a push-up, jump back up, do it again. Nobody likes burpees. But if you went over and you were 2 meters over, the penalty was doubled. You had to do 2 burpees for every meter over. So you can imagine you're trying to figure out, as you're rowing this erg, which has a long lag time, when you stop your last pull, the counter still keeps clicking for a while. So you're trying to get precisely at 200 meters so you don't have to do burpees, because everybody hates burpees. And that's kind of what the Fed's trying to do as it's raising interest rates. It's got these dual mandates: maintain full employment and keep prices stable. And it wants to hit exactly 200 meters. It wants to raise rates just enough that it breaks inflation and doesn't hurt unemployment. But just like rowing on the erg, you almost never get 200. And so that's kind of the design. You're doing burpees, right? It's the gym. You're there to work out. The Federal Reserve's trying to be perfect, and it's unlikely they get perfect. So which side are they going to lean to, right? My trainer said you have to be under. If you go over, it's a 2 times penalty. The Fed has told us unemployment is 3.7 thereabouts right now. They got room to go up to 5, so they're not concerned about unemployment right now. They're only focused on inflation. So if they're going to try to get the specific number that we're looking for, to raise interest rates enough to stop inflation, they're okay going a little bit over, right? Because they got a little bit of slack on the unemployment side. So our guess is they're probably not going to get it perfect and stop on a dime. That's the soft landing everybody talks about, where the Fed nails it, right? It's a little bit interesting if you think the 1,000 PhDs at the Fed who got it wrong predicting inflation are now going to get it right when they nail it on the back end. So they might go a little bit too far, which means a slight recession. So long story, but we're definitely watching the Fed as our second thing. And, probably they might go a little bit too far. When they report out later this week, I think the market's pretty convinced they're going to raise rates 0.5%. And then the market will be looking at the language that they talk about. Are they signaling that they might take a pause, right? Because unlike me rowing on the erg where I have 1 shot, the Fed can continuously tweak their scenario. So that would be a second thing we're looking at. And then as we put together a portfolio, we're always thinking about how confident are we in our base scenario and what else could happen. Right now, the Procyon Investment Committee is cautiously optimistic on where we are, but we know there's a chance that the Fed, pulls a hard landing and it could get worse. So we're being conservative there. Or on the optimistic side, perhaps the worst is over, and with unemployment at 3.7, the Fed has a lot of room to maneuver, and so they'll take advantage of it. And corporate earnings are a little bit off, but not too bad, and the markets will continue. The other thing that we know, which is helpful as a portfolio manager, is that rates are no longer at 0. right? Cash is no longer paying 0. Bonds are not yielding 2 anymore. Bonds and cash are yielding much higher, which gives fixed income a better shock absorber. It acts as a better shock absorber in a balanced portfolio. The yields are higher. Bonds hate rising rates, but they like to exist in an environment where rates are higher because you get to reinvest your coupons or the bonds that mature at ever higher rates. So let me stop there and throw it back to Antonio, keeping an eye on earnings, keeping an eye on the Fed, and we know that we're in a different environment than we were from 12 months ago.
Yeah, no, that's great. We'll talk about a couple of things later on in the where can we be wrong section ultimately, right? Because we do have some baseline expectations, probabilities, and we've been doing this a little while to hedge ourselves. So earnings certainly in focus. If you aren't a student of the market, you don't really know that the vast majority of the losses in the equity markets this year were basically a contraction of valuations, not in earnings losses. And so those earnings losses, are potentially in the future, or earnings shrinking potentially in the future as the Fed raises and tightens. And so we're keeping an eye on that. Shifting gears a little. So we've got market stuff, got macro stuff, got economic stuff. We understand inflation a little bit. We still have to have a plan, right? Ultimately, Procyon Partners is a financial planning firm. We believe strongly in having a strong plan, sticking to that plan, but being flexible enough to know when it's time to make changes and update those things. And so as we talk about investments and as we talk about what we're looking for, I think one of the bigger implications is also, how does this affect your financial planning? Does it affect your financial planning? Does any one year affect that, right? It depends on lots of different factors. There are lots of very specific reasons why it may or may not affect you, and you should absolutely talk to your advisor. However, Mike Kelly is going to share with us a couple of the things at the department level in the division there that they're thinking about for this year, and a lot of the questions that they may be getting. As you guys know, we use some software, and there's lots of information. As Jeff said, there's some things we know and some things we don't know. Financial planning software tries to bake in all the things in the future that we don't exactly know yet, but we can base some good assumptions on. And so, Mike, if you don't mind talking to us a little bit about, financial planning, sort of what are some concerns that are going on, and what's the department doing in order to make sure we account for some of this for the clients?
Sounds good. Thanks, Antonio. Personal financial planning, as we all know, it's an ongoing process. The plans that we put together for collaboratively with our clients may show where we are at a point in time, and that point is constantly moving forward. Inflation is one of the I think most stressful factors that we deal with, and we always we always take it into consideration, even when it's not top of mind with our clients, with the investors. And inflation, as you mentioned, Antonio, over the last couple of decades has at times been relatively low, and of course, when it was low, we didn't make assumptions that it would be lower trending lower for a long period of time. A lot of the plans that we put together, surprisingly, or individuals are surprised to see that their retirement period is actually, in some cases, longer than the period that they were working. So it is important that we take into consideration longer term trends. Again, understanding these spikes, because of course, inflation is it diminishes your buying power. Okay. Now, what we do in the plan, in the individual plans, is identify those components of the consumer price index or inflation that are impacting the individual household. Okay. We've got educational expenses are actually a very small component of inflation, or the measure of inflation. But if you're saving for one of your children, or your children for college, we account for that in the inflation rate associated with educational expenses to be 3 to almost 4 times what the average inflation rate is in general. Same thing with health care expenses. So what in your own household, how much of your income is attributed to these different sleeves. And, for example, if inflation is up tremendously because housing costs are up, and you have no mortgage or you have a fixed mortgage, it's going to that inflationary figure is going to impact you to a lesser extent. So it is very important always to communicate with your advisory team so that your financial advisor knows when you may need to be taking money from the portfolio. If you're drawing regularly, the plans that we put together show a dependable, visible stream of income. We know where our clients' cash flow is going to be coming from for the next 2 to 3 years. We don't want to put our clients in a position or ourselves to sell something that we don't want to sell, good investments that happen to be down in a particular at a particular time. So, large expenses coming up that you may have not communicated to your advisor, that it's important that you do so. I need a new car. We're buying, we have a home improvement coming up. Jeff mentioned that interest rates are up. That helps cash balances. So, to the extent that you are maintaining a cash reserve, it's less unpleasant because your savings account is earning more. But that also means that when you're seeking to borrow money, whether it's a mortgage or a car, a lease, you have to be more thoughtful these days. It's not just call any bank and get a 3% rate or it's 2.9% rate. You may need to shop around. You may want to lean on your advisory team to assist in monitoring. Maybe does it make sense to pay down some debt? Variable debt is very stressful for me when I'm seeing it on a client's balance sheet. And I think that also from a reserve standpoint, we've assisted clients in maybe taking a portion of their reserve that they don't need in the immediate term, and possibly use a termed CD or something else that's available at the bank. Not because we're trying to get a greater return, per se, but just so that it's the dollars are being treated more favorably. Your reserves, the cash flow that you depend on, the return of that money is more important than the return on that money. So again, I think for us, inflation's always top of mind. We've used an inflationary figure between 2 and 3%, pretty much always. We can for clients and advisors that want to be more conservative about the assumption, we can actually create scenarios within the plan where we are assuming not a 2% or a 3%, but what if there's a 4 or a 5% inflationary rate for a period of time? We assume expenses are going to be higher than anticipated, and we assume that income and returns are going to be less favorable, so that we can continue to be prepared. We always plan. We always hope for the best, but we plan for the worst. And we have to prepare for these events like COVID that come out of nowhere. So you take as little risk as you have to provide the highest probability of not outliving your cash flow, and you monitor it every year. Sometimes throughout the year, life events occur, and you have to be prepared. And again, communication is key.
Hey, Mike, also, I think what's important, and I know that we do a lot of this, is that when we enter into a planning relationship with an investor client, whether that be, estate planning and long-term, planning or other planning, there's there's no way for us to know exactly what's going to happen tomorrow or the day after that or the day after that. And so as part of our process, would you just describe the Monte Carlo simulations, as well as what the probabilities mean and what our standard is, because that will help alleviate some of the stress that comes with an environment like this for our planning clients.
Certainly. So we stress test our plans regularly in several different ways. You know, the first thing prior to the Monte Carlo is that we want to make sure that if we assume a certain rate of return, again, underestimated, will that rate of return, assuming a certain inflationary figure, will you meet your spending goals? Number one. Number two, we also apply what we call bad timing to our plans, because you can imagine if you retired in October of 2021, and then 2022 rolls around, you could be a little anxious. So another stress that we apply to the portfolios is if you retire and or the next couple of years, what if you have a really, really bad couple of years at that time or in the next 2 years? And then lastly is the Monte Carlo simulation. So for example, if you retire at 65 and your actuarial age is 95, that's a 30-year retirement period. And so based on let's say the statistical figures associated with our client, with a model or the portfolio that the client is using, the Monte Carlo runs 1,000 30-year periods. And what we want to see is a greater than 75, 80% of those simulations. So 750 to 800 plus of those 30-year periods ending with money at the end of the plan. So anyone who's gone through the planning process has seen that line graph that has, a couple of scenarios very high and some near the bottom. And what we want to do is we want to create as small of a sample size as possible, so that the potential for failure is very, very low. And like I said, that is something that we review on a regular basis. We are actually, the planning team right now is preparing for to refresh all of our clients' financial plans for the beginning to middle of next year. So, if some changes need to be made, we will make them.
Yeah, no, I think that's all a good point. Refreshing is important. Data changes a little bit, but as you mentioned, we're not focused on 1, 2, 3, 5 year periods of time and planning. There is some type of planning that focuses on that, but that's a little different than retirement planning. And so it's important to know that averages over long periods of time are sort of expected. And we change some variations to that based on the client situation and where some of their exposure would be. So I appreciate that. Shifting gears again a little bit, back over to Jeff, we're going to talk a little bit about portfolio construction. As I mentioned, Jeff is one of 4 portfolio managers here at the firm. Mark would be another, myself, and James Diver. And so we have similar, but not exactly the same methods. We like to sort of bake together all of our extenuating knowledge and come up with what we think is the best thoughts ultimately for the investors and clients at Procyon. So Jeff, can you talk a little bit about portfolio construction, and then I'll briefly talk about how we arrived at that as a committee.
Sure. Well, I guess the number one thing when you're putting together a portfolio is it has to add up to 100%. So all your good ideas, you have to whittle down to 100. That's the hardest part. I think the other important thing for the Procyon Investment Committee and the portfolio managers is we're humble. We think we know what's going to happen, but after decades in this business, you're not always going to be right. So when we put together a portfolio, we always have things in there that are kind of working against our base case. So if we like value stocks, that doesn't mean the portfolio is entirely value stocks. If we think it's going to be a difficult environment for fixed income, it doesn't mean you have no fixed income in your portfolio, right? So there's always something in the portfolio that's probably not working as well as you want right now. but there's not everything in the portfolio always going in the same direction, because that's great when it works, but if you get your scenarios wrong and your outcomes wrong, that can be particularly painful. So whether you like the US better than international stocks, I'd say most portfolios are going to have some exposure to the global stock market, not just in the US. Small company stocks are generally more risky than large company stocks, and in a difficult environment, potential recession, maybe we're leaning a little bit more towards large caps, but it doesn't mean we're going to ignore the small caps. So we're humble. It's got to add up to 100%. And there's always a little bit in the portfolio that works in the opposite direction because we're hedging our bets. We don't tend to think in terms of absolutes, but possible outcomes and probabilities. And then when we think about what the Procyon Investment Committee knows, we're also trying to think, is that already priced in the market? We think X, Y, or Z is going to happen. Does the market already agree with us? In which case there's no edge or advantage to take advantage of it. So we're trying to think about what is important that's not yet priced into the market. And the future direction of interest rates is a great example that we've talked about ad nauseum already today, Antonio.
Yeah, no, and I think it's an important factor to know that how not only portfolio construction that we basics that we use, foundational values that you discuss. And I think I also would want people to know that it evolves in the sense that 2-3 years ago, the focus, and sometimes it's a nuance, believe it or not, as Jeff mentioned, right? It's not all value stocks or all growth stocks. It's an overweight or underweight so that we can generate positive returns above a passive investment that's like that, right? So for us, it's important to know that the companies evolve, what we're looking for evolves, and that's based purely on what we're expecting, not what has already occurred. One of the biggest problems in portfolio management and construction is to take what's already happened and backtest it, and then decide this is the way to go forward because it's already worked, it's proven, right? And that's not necessarily the case most of the time. I think you've got to think about some things a little bit more nuanced, which we're doing. So I wanted to just give a couple more minutes on how we arrive at this, right? So how do we know that how do we decide we're going to go value over growth? Is it just Jeff pounding the table? Is it, who is the loudest voice in the committee? Who is it? How does it work? And so what we do is we have voting members and non-voting members of our committee. And we put out a survey quarterly or more frequently, depending on what we want to do. We utilize those survey results to feed the macro committee discussion. So we've got portfolio managers, we've got advisors, we've got analysts, all of that are in our investment committee meetings so that we can hash out some of the answers and outliers within the list or the survey. We call it a pick list. And so what we do is we talk about that. We debate that at the macro committee. We talk about whether or not we think those things are going to happen. And then we discuss all the things that we know. And then what happens is we have a separate committee for just the portfolio managers, whereby we take those ideas and those discussions and we implement them throughout the portfolios. Portfolio managers have some discretion, obviously, because that's why you're a manager ultimately, is you have some discretion in making decisions. And so we implement those things. And so some of the things that have been implemented lately are underweight equities, underweight fixed income, overweight alternatives. And by the way, this doesn't apply to every investor at the firm. Not everybody is the same. So I just want you to think about this in terms of general market overview. There are lots of alternatives and lots of investors that they just will not fit together. It doesn't work. And so we're very, very careful to act as fiduciary on that basis. However, taking a step back, just in terms of asset classes, you start to look at alternatives a little bit more seriously when you're faced with increased risks like earnings and these kinds of things going forward. And so what we voted is we're underweight fixed income, but we're at duration neutral, meaning that we're not shorter or longer than the market in terms of our maturities. We're right at the market or very, very close to it, which means ultimately that while the Fed will raise rates a little bit further, we don't think that they're going to push much beyond what they've already forecast and has already been sort of priced in. And so that's kind of where we stand. On equities, we see increased risks with earnings, increased risk, global deglobalization is there. And so we're underweight there. Overweight alternatives and cash. Cash is overweight simply because it pays to own cash. Now it's worth owning. It's been 15 years. We can get 3.5%, 4.5% on cash, and even better on some short-term treasuries. So that's a very defensive position. We're overweight. Within the alternatives, we've gone a little bit less in real estate and a little bit more in hedge fund in terms of where alternative allocations need to be. And so overall, that reflects sort of not a risk off situation, but a uncertain situation in terms of looking forward over the next year. How do we come out of this new paradigm of higher rates for a longer period? And so we're always looking to preserve capital first, right? As fiduciary advisors, people trust us with that. And then we want to grow and take opportunistic positions if we can. So we'll keep watching those and we'll keep voting and keep you updated. We've got about 5 minutes left. Hopefully everyone is enjoying the rest of their lunch and maybe having a cookie or something. But the important thing that we need to do is understand our own biases. And so groupthink can be an issue. You've got confirmation bias as an issue. You've got survivorship bias as an issue. And so what we tend to do is look at each other and go, well, where can we be wrong, right? The list of where we can be wrong is probably longer than where we can be right. And so we want to focus on that and see what we can do to stem the risk and manage that risk if possible. So something I focus on, and I'll ask Jeff and Mike, same, something I tend to focus on is sentiment. Sentiment is somewhat of a contrarian indicator. So investor sentiment, for example, consumer sentiment's not terrible, and investor sentiment isn't great. Just listening to this call and this webinar and talking to investors and watching the street, and if you got CNBC on, you know that no one is jumping out of their seat positive and that this is a screaming buy. And so sentiment is still pretty low. As a matter of fact, part of our survey internally is, where do you feel we are in the market cycle? And there are a series of different things that you could pick: optimistic, pessimistic, depressed, doubtful, all these kinds of things. And the vast majority at this point picked, I think it was in denial still or something, or don't believe the rally just yet. And so that tends to lead itself to another period of hope, which tends to lead itself to another period of growth, and so on and so forth. While we're aware of that, we think that, I think that paying attention to that sentiment is important because it can be contrarian. So if investor sentiment isn't great, sometimes that's the best time to accumulate assets when no one else is really wanting them. And that's happened over and over again. So those are one of the things that I think can point to us being a little bit wrong just in our general calls. However, through that filter, I still think we're doing it the right way. But Jeff, Mike, any thoughts?
Yeah, I'll use the current events as an example and sneak in a World Cup reference. Nobody expected Morocco to be in today's semifinal. They were 200 to 1 odds at the beginning of the tournament. If they beat defending champions France and take out Lionel Messi's Argentina on Sunday, they will have won the World Cup. Nobody saw that coming. So I realize not everybody's a soccer fan, but it's a great example of being humble about what you might get wrong and being open to information which conflicts with your main hypotheses and being able to change your mind. And that's, I think, a great benefit of the investment committee, is we're constantly challenging each other. That's your hypothesis. What could we do to be wrong? So if you don't have anything to do later today or on Sunday, tune into the World Cup. But that's one thing I did not see coming, is Morocco making it to the semifinals, Antonio.
Great. Mike.
As far as sentiment in general, or specific to an individual's balance sheet or their own planning, what we're seeing is that obviously our clients have been great savers. They're not necessarily great spenders at times, and markets like this start to impact how they do want to spend their dollars. I encourage those who are not having these conversations with their advisor to have the conversation, because we have accounted for the travel expenses and the gifting well in advance of this year. So those dollars are already ready to go. So before you start to kind of tighten your belt, have that conversation with your advisor.
Awesome. Yeah, that's a good point. Markets have black swans, so does planning. You get a sick person in your family, God forbid, or you lose your job, or God forbid something happens. And so, that is agnostic to the market. And so that's something that could always happen. Appreciate that, Mike. Well, I'm going to let everyone go. Got 1 minute to spare, right on time. Thank you for joining. Appreciate having you. Hopefully you enjoyed this. Reach out to your advisor for any questions, comments, and thanks. We'll see you again soon.